So yes, we believe based on finance theory 101 that diversification is of course important when we're looking at reducing risk long term. However, we also believe there are systemic problems that require systemic solutions out there that are complex, that require certain innovation, investment in both innovative finance tools like carbon credits, but also in, sustainable agriculture, sustainable forestry, things that are not purely, growth stocks in the public market, in the social media, space, for example, where of course you can get a short-term return, but we're not solving large-scale systemic issues that are long-term. And I think so. A couple things on risk return and time horizon. Foundations and pension funds and some of these big institutions, they have a longer term time horizon than the average retail investor. And by retail investor, we mean, most of us who just can buy, a portfolio of stocks, bonds, and maybe a little alternative investments. But these big asset owners that have billions on their balance sheet, they can actually take a little bit more risk, invest more in illiquid parts of the market, alternative investments, which is where Alix and I find focus our time. And in that case, diversification remains important. But when we're looking at all the drivers of climate change, for example, which are industrial production, land use, in real estate and construction, transportation, and agroforestry, well, then we can't solve it with just one simple solution. We need to find entrepreneurs all over the world, corporates. We need all hands on deck. No one solution will be the solution. And therefore, we also have to invest in a lot of different types of managers that are deep and niche in their focus. The market 20 years ago didn't have a huge swath of this type of managers, but now we see many, many quality, smaller, and by small, I mean still, managing multiple funds, maybe in the $100 to $1 billion or even $2 billion range, but are doing things like sustainable ag in Brazil with incredible depth, working with all the stakeholders to bring together the native peoples, the government, to find, workable financing structures that include philanthropy, the Brazilian Development Bank, private capital, and come together with different risk and return and time horizons to make sure these projects can get off the ground. So when we say we believe that we want to invest in best-in-class managers who are doing things really profoundly with intentionality, yet are multi-asset class, multi-sector and geography, we're still building a diversified portfolio that is looking at risk and return in many different ways and actually offsetting and balancing out some of those risks in the way we're constructing and thinking about the portfolio. More specifically on a deal level, like we could see an investment, for example, in access to e-mobility charging services in low-income neighborhoods. A lot of people haven't bought an electric car yet, but if they don't have access, they're never going to. They may not be able to afford it. So there's certain subsidies at multiple levels that need to take place to provide the asset to the community, to make sure that they can finance the purchase. And that way we can get to reducing transportation emissions, which account for 29% of US emissions, the largest driver. So it's in our best interest as a society, taxpayer money, et cetera, to invest in these things today and take different layers of risk in the capital stack to be able to commercialize them later on.